Let's get started. So in the last session, let's just say the quick recap of what we did look at in our last session. So in our last session, we did look at in our last session we did look at in our last session we did look at information systems. So just a quick recap. We did look at the levels of management, the elements of information systems. We did talk about cloud computing, the benefits of cloud computing, the dangers of cloud computing. We also did look at the controls that you're supposed to put in place to safeguard information that we have stored on the internet. Remember, cloud computing involves storage of information on the internet. So we did look at some of the controls you need to put in place to safeguard the information that we have put on the internet. Then besides that, we also did look at the sources of information, the internal and the external sources. Then the cost of producing information. So there are costs associated with getting the information and processing it. So we have the data capture cost, the processing cost, and costs associated with inefficient use of information. We did also talk about the different types of information systems. We have the management information system, the transaction processing system, the decision support system, the executive information system, the customer relations management system. We also did talk about big data, which is data that is huge that we can't manage using manual processing system. So we did talk about the big data. So the big data and the big data analytic tools. We also did look at the characteristics of big data. So data is said to be big because of its, number one, because of its volume, because of its velocity, because of its variety, because of its veracity. So these are some of the characteristics that make information be classified as big data. Also looked at the importance of being able to manage big data in the organization. So having systems that can process large volumes of data, it can be an advantage to the organization. It can help us monitor the customer's behavior. It can help us gain competitive advantage. So it can help us gain competitive advantage. Then we also did talk about the challenges associated with big data and big data analytics. So the challenges associated with big data. And also we did mention what data analytics cover. So that is now processing or analyzing the data that we have gathered so that we can be able to derive a useful meaning from that data. So let's move on. Then we did also talk about how we can visualize the data. So we can make use of the bar graphs, we can make use of the pie charts, we can make use of the line graphs, we can make use of the scatter diagrams. Then also we did talk about, we introduced the costing methods. So we have the target costing, the life cycle costing, marginal and absorption costing, activity-based costing, and the environmental costing. So under that, we might also need to add throughput accounting. So it's part of the costing methods that you need to be aware of. So we did talk about why is it important to know about the cost. The cost information is the basis for pricing. For you to make the pricing decisions, you need to be aware of the cost, because for you to be able to make a profit, you must price it. You must price above cost. Your prices must be above cost. So the cost information is very useful when making pricing decisions. Cost information is also useful to be able to value our inventory. Remember, inventory is valued at the law of cost and net realizable value. So for us to value inventory, we need to know the cost information. Then we also need to know the cost so that we assess our profitability margins. Then we did introduce the first costing method, which is target costing. So under target costing, I did mention that this is a situation where you want to go and sell a product in a market where maybe there is already an existing price for that product. So we are going to sell a product in a market where the selling price is already determined. There is already a price in the market. So there's already a price in the market, and the profit that we want is fixed. We can't tamper around with the profit. So we are going into a market where there's a fixed selling price, and also the profit that we are targeting is a fixed profit margin. So what we can only play around with is the cost. So how do you get the targeted cost? You say the selling price minus the profit that you desire. So from the price which is available in the market, if you deduct the profit that you are targeting, then you are going to get your targeted cost. But in most instances, we did mention that the targeted cost is different from the actual cost. So you are targeting a certain level of cost, but that is not going to be the same cost that you're going to incur. So if you're actually incurring a cost which is different from the cost that you are targeting, then they say to be a cost gap. So when the targeted cost is different from the actual cost, then they say it to be a cost gap. So it means we have to find ways to reduce the cost gap. So we did talk about the ways that we can use to reduce the cost gap. So we are reducing the actual cost to a certain targeted cost gap. So there are various ways or measures we can implement to reduce our cost gap. Then also the factors we need to consider before maybe we are saying we are going to use this method, or before we say we're going to reduce the component, we are using cheaper suppliers. The factors that we also need to consider, such as, are we not going to compromise the quality? Are we not going to compromise the quality? I think there's something that we missed there that I would want us to add to our Excel sheet. So target costing tends to be of a challenge to use in a service industry. So target costing is mainly applicable if we are dealing with products. So target costing is a challenge to use in a service industry. So let's maybe put that as an NB point. Target costing is difficult to use in a service industry. So in service industry, this is where we are providing intangible items, like in teaching, it's a service industry. So in service industry, the characteristics of services make it difficult to apply target costing. Which are these characteristics of services? Because of the characteristics of services, it becomes difficult to use the target costing approach. So the characteristics of services are that if it's a service, let's say have a subheading characteristics of services. Morning, Manani Moshov. We haven't covered much. So we're just recapping what we did discuss in the last session. So I was actually now adding something to the notes that we had. So we said target costing. We did look at target costing rather. So I added the point that it's important to note that target costing is mainly used if we are dealing with products. It's difficult to use if we are dealing with services. So what makes target costing difficult to use in services is because of the characteristics of services. Characteristics of services. So let's look at the characteristics of services that make it difficult to apply target costing in services. So services, if we are providing a service, number one is intangible. So a service is intangible. If you're saying a service is intangible, it lacks a physical substance. You can't touch a service. So if we are saying we want to reduce the number of material, how can you reduce the number of material? It becomes difficult. It's something that is intangible. A service is intangible. That's number one. Then also a service is inseparable. Inseparable, it means that you can't separate consumption and production. Like right now, I'm producing the service and you are consuming it. You can't say, you can produce it, say, then I'll consume it later. Kajinji, a service, the production and consumption takes place at the same time. So some of those ways we're saying, okay, to reduce the cost gap, we can work, first of all, determine the cost. It becomes difficult because the production and the consumption is actually taking place at the same time. So a service, production, and consumption takes place at the same time. Then also, there is variability. For a service, you can be providing the same service, but it can be delivered in different ways. We can be teaching the same subject. So we can't necessarily charge it the same because our teaching styles can be different. So variability. So we are saying that if the service is provided, it can be homogeneous, or we can say variability. We are saying that the service, it cannot be, it can be provided in different forms. It's the same service, but we can provide it in different forms. Then also a service has perishability. If you are not there, we can't store the lesson. Once I've said it, unless maybe we had to record it somewhere, but a service is perishable, provided that it's a service that has not been recorded. Once I deliver the lesson and you are not there in the lesson, we can't say we are going to, you can keep that and have the lesson later on. So a service is perishable. So variability, we are saying that it comes in different forms. So it can be the same service, but it can be provided in different forms. Then perishability, we are saying a service is rarely stored. It's very difficult to store a service. Maybe if you are to look at a service like what a doctor provides, it becomes difficult for a doctor to say they're going to provide the solution and store it, then the patient can obtain the solution later on. Normally, you have to be there and you have to be receiving the solution. So it's perishable. It can't be stored. Okay, so these are characteristics of services. So you might maybe just find it in multiple choice questions, saying what give us the characteristic, which one of the given is a characteristic of a service that makes it difficult for us to apply target costing. Maybe let's add on one more characteristic of a service is non-transferable. Non-transferable. You can't resell a service. So an asset, you can buy an asset and transfer it to another person. But a service, you can't transfer it. So you can't retail a service. So these are characteristics of services that can make it difficult to apply target costing in services. Now, let's get to life cycle costing. So in life cycle costing, we're saying that a product has different stages in its life. So a product goes under the research and development phase. So research and development phase, this is where we are deciding on how the product is going to be like. So research and development, we are producing the prototypes, we are producing samples before we have officially launched the product. So we're still deciding on how the product is going to be like. Then after the product has been, after we've conducted the research and development, the next thing is to introduce the product in the market. So the introduction stage, this is where the product has been launched in the market. So after the product has been launched in the market, it then starts growing. People get to know about the product. The early adopters buy the product, about the product. So the growth stage, the product is now dominating the market. So during the growth stage, the sales of the product are rising, and market information and the market is becoming aware of the product. So the growth stage, the market is becoming more aware of the product. So that is the growth stage. Then after the growth stage, the product gets to the maturity stage. If the product has reached the maturity stage, this is the stage where the product has dominated the market. The product has dominated the market. So if we are now in the maturity stage, the product is now well known, it is now dominated the market. So in this case, the proportion of new buyers is now falling. So this is now the stage where it's very important to maintain our position in the market. Because yes, the product is now well known in the market. There are a lot of people that are buying the product, but we are less likely to be getting new buyers. So we are likely going to be getting the repetitive or loyal customers that are buying from us, but less of new customers because the product is now dominated the market. A lot of people now know about the product and they are now affiliated to a certain supplier. Then if we are not careful after the maturity stage, we then get to the decline stage. So the decline stage, this is the stage where the product is now losing relevance in the market. The sales of the product starts falling. So at this stage, the product, you can say in some cases, the product is now out of fashion. So people now prefer new versions. They are no longer loving the product. So if it's now the decline stage, the sales of the product starts falling. So in the decline stage, the sales of the product starts falling. Then, so these are the stages in the life of the product. There are costs which we can incur at each stage. So starting from the research and development, we incur costs. We move to introduction stage, we incur cost. We move to the growth stage, we incur cost. The maturity stage, the decline stage. So there are costs that we are going to be incurring at each of these levels. So in life cycle costing, we are predicting the costs. We are not dealing with the actual costs, but we are dealing with the estimated cost. So in life cycle costing, we predict the costs and the units should be produced at each stage of the life of the product. So we're going to predict the costs that we're going to incur together with the units. Like we can say stage the cost, the units. So the stage, then we have the cost, then we have the units. So research and development. So the research and development stage, we have research and development. After research and development, we move to the introduction stage. After the introduction, we move to the growth stage. After the growth stage, we move to the maturity stage. After the maturity stage, we move to the decline stage. So these are the stages in the life of the product. We have, we can say, we have the research and development, introduction, growth, maturity, and decline. So you estimate, if it's life cycle costing, you are going to estimate the cost and the units. Take note, the cost and the units are not the actual, but these are estimates. We are going to estimate the costs and the units at each level. We are going to estimate the cost and the units at each level. We are going to estimate the cost and the units at each level. Just a moment. So we are going to estimate the costs at each level. We are going to estimate the cost at each level. So the cost at each level, let's start with the research and development. So let's start with the research and development. So at the research and development stage, let's say maybe, because if you're in the research and development stage, this is the case where in most cases you incur quite a lot of cost because you are still trying to gather more information about the product. So you incur a lot of costs as compared to the units. So maybe the units you can just produce samples. So let's say you have incurred a cost of 50,000 and the units you have produced, or maybe even 10, just as a sample. You just produce 10 units as a sample. Then introduction stage. still the costs are still high. You need to market, you need to find the location. So the cost, let's assume that's 60,000. But as you're introducing, you might start with a fewer number of units, let's say 100. The growth stage, now the cost can be, maybe for the growth stage, the cost can rise slightly because now you are marketing a lot and the products are also increasing. So the growth stage, you can estimate that we are going to maybe provide 1,000 units. Then the maturity stage, our costs, let's say the product is now well known, so the cost 65,000. Then the units, we're expecting to sell much of our units at this level. So maybe we can say 5,000. Then the decline stage. The decline stage now, we can be estimating that the costs are going to fall as well because now the product has less relevance in the market. The units are going to fall. So the units we can sell in the decline stage. Let's assume we sell 800. So these are the estimated total costs. We are estimating the total cost for each level. And we are also estimating the units for each level. So these are still estimates. Please take note of that. So life cycle costing then says the total estimated cost over the total estimated units. So our life cycle cost, we then say our total expected cost. Let's add up the total cost. So our total expected cost, right from research and development up to the end of the life of the product. So those are the costs. Then let's also add up. Let's also add up the total expected units. So the life cycle cost then becomes the total expected cost over the total expected number of units. The life cycle cost is the total expected cost over the total expected number of units. So that's our life cycle cost. So it means for our life cycle cost, we are saying each product is an estimated, if you round the nearest two decimal places, is an estimated cost of $39.80. Each unit has an estimated cost of $39.80. So when you're now giving a price to this product, we then make sure the price doesn't go below $39.80. Why do we do this? It's because if we don't estimate the total life cost of the product, we might end up failing to recover some of the costs. So if we consider, for example, here, let's consider the price at maturity stage. So at maturity stage, each product is going for all the costs are going to be 65, but the products are 5,000. It means each cost per unit is 13. So if you decide to charge $15, saying that since the cost at the maturity stage is 13, if I charge $15, I'm making a profit. You might be able to recover the cost at maturity, but you might also fail to recover some of the costs that you incurred in research and development, or some of the costs that you incur in the decline state, of which is also not ideal to be changing the product's price regularly. Because if you start changing the product's price at each stage, that can end up affecting your market share. So we need to come up with a fixed price for the product, which is going to incorporate all the costs that you're expecting in the life of the product. So now you can be able to say, maybe the price for the product is $45. You are guaranteed that in all the stages of the product's life, you are going to be making a profit. So you are guaranteed that the price you are going to charge is going to give you a profit. So the key benefit of life cycle costing is that it can help us assess the profitability. So you can say advantages of life cycle costing. So advantages we can derive from life cycle costing are that, number one, we can be able to predict the profitability of the product in time. So it can help management assess profitability of its products. Can help management assess profitability of its product over the full life. So the product might be just profitable for the first years, but if it's life cycle costing, you can be able to assess all the costs that you're going to incur. So we know overall, will the product give us a profit in its life. It also assists in better decision making. So we make more informed decisions. We make better decisions. So better decision from having an overall view of how the product is going to perform. So if we can be able to estimate the life of the product, if we realize that the product has a short life, we then can decide to charge high prices so that we can quickly recoup the cost. So if you realize the product has a short life, it's very important that you quickly recover your costs before the product goes out of market. So we can be able to assess so we can be able to make better decisions. Then also, it is also a way of long-term thinking. So it encourages long-term thinking and planning. Because in life cycle costing, you are forced to actually determine the price at each level. And the cost, you are forced to determine the cost at each level before production. We actually plan. If the product is going for 3 years, it means we have to plan the cost for each year for the next 3 years. So it means that we are forward thinking. It helps us to look into the future. It helps us to forward think. Okay, let's move on. Besides life cycle costing, Or maybe they can also, there's an area that you need to be aware of as well, that if we want to maximize our profit from the product, we need to implement the following. So if you want to make sure you maximize your return from a product, you need to implement the following. So to maximize the return from the product. So to maximize the return from the product, the first thing is you need to make sure you remove unnecessary cost. Remove unnecessary cost in the design of the product. So in the research and development, remove unnecessary cost, because the higher the cost, the lesser the profitability you are likely to get, because it will affect your price. So design, or we can say reduce the cost of manufacturing the product. Identify non-value adding costs. There could be costs that you are incurring that are not adding value to the overall product that you have produced. So identify those costs that are not adding value to the overall product. Then you can then decide to reduce those non-value adding costs so that at least you will be able to charge reasonable prices. Then you can also minimize the time to the market. So don't spend a lot of time in research and development. What happens if your competitors get to know of your product that you are designing, and they can take advantage of that and be the first to produce before you have actually launched your product. So you need to make sure once you have started your research and development, you don't prolong it to an extent that maybe the research becomes irrelevant by the time you develop the product, or maybe the competitors can get to know of the product and also produce substitutes before you. So you need to make sure you minimize the time to the market. Quickly launch the product in the market. Don't delay the time before launching the product in the market. Then also minimize the break-even. Minimize the break-even time. So if you're minimizing the break-even time, the break-even, remember, this is the time where we are able to recover. The break-even, this is the time we are able to recover. The break-even is the time we are able to recover our cost. At break-even point, the firm is neither making a profit nor a loss. We have recovered our initial cost. If you're operating at break-even, our costs are equal to our revenues. We've neither made a profit nor a loss. If a firm is operating at break-even, my costs they are equal to our revenues. We are neither making a profit nor a loss. So we need to quickly reach the break-even point. We need to charge a price that can enable us to quickly reach the break-even point. So you minimize the break-even time. How do you minimize the break-even time? By charging a price. If you charge a price that is, if you charge a reasonable price, it can help you recover the cost quickly. So you need to charge a price that can help you minimize the time to break even. That can help you quickly recover your cost. So if you charge very low prices, competitors can introduce other substitute products, or can introduce other competitive products where you might fail to recover the profit to recover the cost or make the profit that you intended. So you need to make sure before your competitors have actually launched similar products, you have already recovered the bulky of the cost. So you need to minimize the break-even time. Then also you need to maximize the length of the lifespan. Of the lifespan. You need to maximize the length of the lifespan. So we are saying the product, we should try to make sure it stays in the market for a long time. So try to extend the life of the product. How can we do this? We can extend the life of the product by maybe introducing new types, new versions, new brands. So try to extend the life of the product. So by extending the life of the product, that can help you make a profit from the product for some time. So these are some of the ways you can use to maximize the benefit you are getting from the product. So make sure you reduce unnecessary cost. Also, minimize the time you take before launching the product, because competitors can overtake you, and you can lose out on what you're expecting. So take very short time between research and introduction of the product. Then also minimize, quickly recover the cost, that is, have a short break-even time. Then also maximize the length of the lifespan. Then let's move on. We have quite a lot to cover. So now let's quickly summarize some of the key concepts on marginal and absorption costing. So marginal and absorption costing, these are assumed knowledge from management accounting. So we are not going to go into detail with that. So for management accounting and for marginal costing and absorption costing. Let's start with marginal costing, which is sometimes called contribution costing. So if we are applying the marginal costing approach, so under the marginal costing approach, we are only considering the variable cost in decision making. So marginal cost only incorporates the variable cost. So we can say that these techniques values inventory. This technique values inventory. This technique values inventory at total variable production cost. It values inventory at total variable production cost. So variable production costs, remember the variable costs, these are the costs that increase with the level of output. So variable costs are the costs that increase with the level of output. The more we produce, the more we incur these variable costs. The more we produce, the more we incur these variable costs. So if we don't produce, you don't get these variable costs. They increase with the level of output. So in marginal costing, inventory is valued at variable production cost. So where is it different from the absorption costing technique? So if it is the marginal costing technique, we value inventory at total variable cost. Then if it's absorption costing, so they won't ask you questions for you to maybe prepare the marginal cost income statement in most cases. So what you need to know from your previous knowledge, how is marginal and absorption costing different? So absorption costing. So this one is sometimes called the full costing or the traditional costing method. So if it is the absorption costing, unlike the marginal costing, this values inventory. This values inventory at full production cost. And by full production, what do we mean? We are saying variable plus fixed cost. So that will give us the full production cost. So if we say the variable plus the fixed, we get the full production cost. The variable plus the fixed, you get the full production cost. That's the first difference. Absorption costing values inventory at full cost. But if it's marginal costing, it just takes into account only the variable cost. Maybe let's simplify this. Let's think of someone who is operating in a tuck shop. If you're operating in a tuck shop and you want to determine the selling price of your items, in most instances, you just consider the price you have bought the item at. In that price, you don't, when you're now determining your selling price, you don't include the wages of the shopkeeper. You don't include the cost of the rent. You have just considered the cost of the material or the cost of the item you have bought. So that's a marginal costing approach because you have decided on the selling price without taking into account all the costs that have been incurred by the business. You have just taken into account the cost of purchase, which can vary with the level of output. If you buy more or if you buy at a higher price, you're going to be charging more, but basing only on the purchase price. You are not including any other costs that are going to be incurred by the business. So the cost you are going to be including is not including all the costs. So that's how the marginal costing approach does. But this one is now looking on the production side. The cost of production that we are including are only those that increase with the level of output. The costs such as the rent for the warehouse, such as the salaries for that we are going to be paying for electricity, and so you can look at the factory electricity, those that we are going to pay that are not directly concerned to one product, those ones are not included. We only include the variable cost. Then absorption costing, on the other hand, takes into account all the costs of production when you're determining the values, when you're determining the value of inventory. So that is the difference. Then if you calculate profit using the marginal costing and absorption costing profit, this can give you a difference. Why? The difference in the profit the difference in the profits for marginal and absorption costing. The difference in the profits for marginal and absorption costing are as a result of the difference in closing stock. Are as a result of the difference in closing stock. So the difference in the profit is as a result of the difference in closing stock. Closing stock valuations. If there is no closing stock, we are likely to get the same profit if there's no closing stock or opening stock, but the differences in inventory contribute to the differences in profit. So how we are going to value the inventory determines the profit we are going to get. So the differences in inventory, that is opening and closing inventory, and also how we are going to value the inventory gives rise to the difference in the profit. Let's move on. Let's move on. I think regarding marginal and absorption costing, we can end there, but we are going to compare absorption costing with activity-based costing. So the key takeaway from here is marginal costing values inventory using variable cost. Absorption costing takes into account all the costs. That is, it uses the full costing method. Then maybe one more point to take into account is if the inventory, that is comparing the opening and the closing inventory, if the inventory levels increase, absorption costing reports a higher profit. Reports a higher profit figure than marginal costing. So if the inventory levels are increasing, absorption costing reports a higher profit than marginal costing. So profit and the closing stock, they are somehow directly related. So if the closing stock is high, or if closing stock is valued at a higher price, we are also going to get a higher profit. So NB, if the value of closing stock is high, then the profit will be high. If the value of closing stock is high, then the profit will also be high. So the profit is affected by the value of closing stock directly. That is, if the closing stock is high, the profit is also likely to be high. Let's move on and talk about the absorption costing versus the activity-based costing. So we have what we call the activity-based costing. Activity-based costing. So activity-based costing is more of an advance to the absorption costing technique. So the activity-based costing is there to try to solve some of the problems which were caused by absorption costing. Absorption costing was ideal to use when the organization had few overheads. But now, because of the technological advancements, companies are now having a lot of overheads. And it becomes less ideal to use the traditional costing method or absorption costing method to allocate overheads. So what was the case if you are using absorption costing? Maybe let's have a simple example. So under the absorption costing, we would say direct material. So we have product A and we have product B. Let's deal with these two products, A and B. So we can have the direct costs, such as material and labor. So for A, let's assume the direct costs are $15. And for B, the direct costs are $34 per unit. These are the direct costs per unit. Then a total of can be told that a total of besides the direct cost, sorry, we can also be told the labor hours per unit. The labor hours per unit, you can be told this one is using 2,5, and this one is using 3 hours. A total of 2,000 units of A were produced, and we can say 2.5 of B. 2.5 of B. 2.5 of B. So these are the units produced. And we are also told the overheads incurred were as follows. The overhead incurred were as follows. Machine costs, $8,000. Machine costs, we can be told we also have maintenance. $10,000. Let's just give the other one the name, other overheads. Other overheads, 20,000. Total overheads. So the total overheads becomes 38,000. So under the traditional absorption costing technique, we would assume that the cost of overheads, the 38,000, we can share it just using one base. So we can share this cost among these products using one base. So if we want to share the units, the 38,000 to these units, under the traditional absorption costing, we could use one base. Like the question would say, the overheads are absorbed on labor hour basis. This means that all these costs, we are sharing them based on labor hours. So we are assuming that a product that has more of labor hours is getting more of the cost. So that would be the traditional approach where all the costs, they are just shared using one base. How would we share the cost? The question would maybe say, what is the cost per unit? What is the cost per unit? What is the cost per unit? So for the cost per unit, we are going to get the direct cost plus the overhead cost. So for the cost per unit, we have the direct cost plus the overhead cost. So the direct costs are not difficult to get because they'll be given, but the overhead cost, this is where the problem was. So if it's the absorption costing, it assumed we can share the overhead using one base. So how do we share the overhead? In this case, you calculate your overhead absorption rate using one base. So you say your total budgeted cost over total base. Total budgeted overhead over total base. So the total budgeted overhead, we are adding up all the budgeted costs, and we have been told these give us 38,000. So the total budgeted overheads, if we add them up, they are giving us 38,000. The total budgeted overheads, if we add them up, they are giving us 38,000. What about the total base now? Pay attention to this part. So they are saying that the organization was sharing the cost that it has incurred based on the hours, with the assumption that a product that uses a lot of hours should get also more of the cost. That's the criteria that they were saying. If we are sharing the overhead, let's share it based on the labor hours. A product that had more hours let it get more of the cost. So in this case, we were budgeting that each unit of A uses 2,5. Each unit of A uses 2,5 hours. It's labor hours per unit. Each unit of A uses 2,5, but we are budgeting to produce 2,000. So it means the hours needed for A is 2,5 times 2,000. Plus, for B, it was 3 times 2.5. So this will give us the total hours we are expecting for all the units. So now we have the total cost, the total budgeted cost, and the total hours, labor hours we are expecting. So can you work that out for me? What's our total budgeted hours? What's our total budgeted hours? It's what? 12.5. So what is this? What is this saying? So it means we are expecting that we are going to incur an overhead cost of 38,000, and we are going to use up a total of 12,500 hours. So the total cost is 38,000, and the total number of labor hours is 12.5. And we are saying each unit, we are going to give it an overhead cost based on the hours it has spent. So what is the overhead cost per? Now we want to calculate the cost per hour. So we're going to share the overheads based on the hours spent. What is now the overhead cost per hour? 38 divided by 12.5. This will give us the allocated overhead cost per hour. 10? 3.64. 3.04. 6.04. Diesel. 3.04. Okay. Per hour. So we're saying for every hour, year labor, we are going to give the product an overhead cost of 3.04. So remember the total cost, we say the direct cost plus the overhead cost. So it means now we can go and calculate the cost that we are going to allocate for each product. So we have the direct cost. We have the direct cost, which is given 15 and 34. Then the overhead cost, we are going to base, the question was saying, the firm absorbs the overheads based on labor hours. So the overhead cost, we are going to say, each labor hour is going to be given an overhead cost of 3.04. But for product A, each unit used 2.5 hours. So we then say there's 2.5 times the cost. We then come here again, you say, think for B it was 3. Then say 3 times 3.04. So we are now absorbing the cost into each unit based on the labor hours we're expecting for each unit. So we said the costs are going to be shared based on the labor hours. So since we have the labor hours, let's calculate the cost we shared for each hour. Now we have the cost for each hour, 3.04. We then now absorb that into the product. So overall, this becomes 22.6. Here it becomes 43.12. So when you're now charging the price, now we have the full cost per unit, the direct and the overhead cost. If it was marginal, it would just charge the price based on the 15 and 34. But absorption incorporates the overhead cost per unit. So it means if we are using the traditional costing, we would charge the price based on these 22.6 and 43.4. That's what we would use to determine the price. That's what we would use to determine the price. That's what we would use to determine the price. It's total cost now. The variable are the direct costs. So this is now total cost. The overhead are the, so the direct costs are the variable cost. Remember, if it's not variable, then it is either fixed cost or you can call it overhead. So this is now the total cost, which is incorporating the variable direct costs and the overheads. So the price charged is then based on the total cost so those are, that is if we are using the absorption costing. So we haven't started talking about the activity-based costing. So this was the traditional approach. But this approach now is becoming less relevant. We can't say for all the costs, we're just sharing them based on one base. Because organizations nowadays have a lot of overheads that they're incurring. So it's not ideal to have one base to share overheads. How can we share the machine costs based on labor hours? So sometimes using the absorption costing is not ideal. We need a base for every overhead. So we need to identify what is causing the cost. It couldn't be, we can't have the machine cost being associated with labor hours in most cases. So for every cost, we need to identify what is a cost driver. So we can say the problem with absorption costing or traditional costing is allocating all the overheads using one base. Allocating all the overheads using one base. Allocating all the overheads using one base. So this actually gave birth to activity-based costing. The activity-based costing if it's now the activity-based costing, it identifies for every overhead, it identifies a cost driver. So this approach identifies a cost driver for every overhead, which in this case we call it a cost pool. So for every overhead, we identify a cost driver. So we want to make sure if we are sharing the machine cost, we find the best for the machine cost. If we are sharing besides the machine cost, the maintenance, we find the best for the maintenance. So for every overhead, we identify a cost driver. What is a cost driver? The cost driver is the activity that is causing the cost to increase. What is it that is causing the cost to increase? Maybe another point worth noting is the absorption costing. This approach was also ideal. Just fit it in somewhere. It was ideal for overheads that were volume driven. So it was ideal when overheads were mostly volume driven, meaning the cost increased with output. So the absorption costing approach was more ideal to use when overheads were volume driven. However, this is no longer ideal for most organizations. So organizations used to have the same processes, and also the overheads were somehow affected by the number of units. But nowadays, the overheads are being affected. So the overheads are being affected by a lot of factors, not just volume. So for every overhead, it's very important to identify what is causing the cost to go up. So if you're now sharing the machine cost, we don't share it on using one place with the maintenance. But for every cost, we identify a cost driver. For every cost, we identify a cost driver. So for every cost, we need to identify a cost driver, which is that which is influencing the cost. Then the cost that we are incurring, we can call it the cost pool. So the cost that we are incurring, we can call it the cost pool. So there are common cost drivers, like we can say cost pool. I'm just going to list the common ones. And this side, we have the cost driver. So the question might not give you which driver to use. You need to identify the cost pool and the cost driver. I will demonstrate that. So you need to also be aware of some of the basic cost pools and cost drivers. Like if the organization is ordering, the ordering costs, that one can be shared based on the number of orders. That is the cost driver. If we are sharing the material handling costs, these can be shared so the material handling cost, we can share it based on the number of production runs. Then the machine setup. Machine setup costs, you can share that based on the number of machine setups. So as we are producing, we might need to place orders. So the more we place orders, the more we incur ordering costs. So the more the orders, the higher the ordering cost. So if you're sharing the cost of placing orders, it's wise to share it based on the number of orders. Then the material handling costs. So this is affected by the number of production runs. The more we run production, the more we are likely to incur handling costs. So if the organization is sharing the handling costs, it can be based on the number of times we are running production. Then machine setup costs. This can be the machine setup costs. We can look at how many times are we setting up the machine. Then also we can have machine operating costs. Then so machine operating costs. So the machine operating cost is number of machine hours. So the machine operating cost. So the cost of operating the machine can be associated or influenced by how many hours. So the number of machine hours can influence the cost of operating the machine. So the machine operating cost is affected by number of machine hours. So the more the hours, the more the machine operating cost. Then production scheduling costs. Lisa? Production scheduling costs. This can be affected by the number again of production runs. So number of production runs. So production scheduling costs, number of, so these are some of the costs you might come across. Number of production runs. Then also they'll give you the cost pool. You have to now identify which cost driver can I use for this cost. We can also be given dispatch costs. You can also be given the dispatch costs. So these ones are affected by number of orders dispatched. number of orders dispatched. So for some, if they give you other drivers and cost pools, some of them you can be able to tell, like ordering costs. That goes along with number of orders. If you are talking about machine setup, number of machine setups, so the cost will be given, and you have to just link it with the cost driver. So going back to our example above, if it is now that we are using activity-based costing, we are not going to just share all these overheads using one bus. We're not going to share all the overheads using one bus, but for every overhead, we are going to identify a cost driver. Let's modify the question. Let me copy it, then we modify it. So if it is now ABC costing, they will give you extra information. They will give you extra information, like what? So we're given the number we're given the labor hours per unit. They can also give you, let's change the maintenance and put, so we have machine costs, let's say machine setup. Machine setup costs, machine setup costs, then we're going to have ordering costs, then other overheads. Let's change the other overheads and maybe put we can say materials handling. Or instead of material handling, we can say packaging costs. The organization uses a manual system for packaging. Then let's add to this, we have number of machine setups. Number of machine setups. Then besides the number of machine setups, we can also have, so if the number of machine setups, we can have the number of orders. Number of machine setups, we can have number of orders. The number of orders. Oh, let me just modify again. I need to put something. Number of machine setups. Let's say there are 30 here. Number of orders. Let's say there are 20. Number of orders. 150. Number of orders here, we can have 120. So I think now we can make use of the information to derive our answer. So if we are using the activity-based costing system, what is the cost per unit? Using the activity-based costing. I think this statement is no longer relevant. We can remove this one. This was what is the cost per unit using activity-based costing? So after this one, we're going to look at we are going to look at the structure of a real question and apply what we have been discussing. So okay, let's proceed. Sorry for the disturbance. So I was saying that the question was, what is the cost per unit using the activity-based costing approach? Please pay attention. So if we are using the activity-based costing approach, the key difference number one, the overhead is still 38,000, but we're not going to share it using one base like we did for like the approach that we did for the traditional costing. But for every overhead, we need to identify a cost driver. And calculate OAR. So for every overhead, we need to identify a cost driver and calculate overhead absorption rate. We need to identify a cost driver and calculate overhead absorption rate. So we have three overheads. Maybe before we get to that, remember, it's still the direct cost, as the overhead cost. The only difference is that how we are going to calculate the overhead is what is now different. It's still the direct cost plus the overhead cost, but how we are going to work out the overhead is what is differed. And the direct cost is not going to be affected. So we are then going to say let's first of all work out the overhead cost. We start with the first overhead, the machine setup costs. You then come to the information above. Then come to the information above here. You identify which base do we use to share machine setup cost up. What do you think we should use to share machine setup cost? It's the number of machine setups. So overhead absorption rate for the machine setups, you take the overhead for the machine setup, the 8,000. That is what we call the cost pool. So you're going to take the 8,000 is the cost pool over the total machine setups. We divide over the total machine setups that were done in that period. So if the question did not say per unit, please take note. The question, if it did not say, like the labor hours are said to be per unit. So when we're calculating the total labor hours, we had to multiply by the number of units. But in this case, the setups are not given per unit. They just said the setup. If the question is silent, the assumption is these are all setups. It's not per unit. So we are not going to multiply by the number of units because 30 is actually assumed. 30 is for all units of A. And the 20 is for all units of B. So the total, you are saying to get the OAR, you're going to say the 8,000 cost over the total machine setups, which is what? The 30 plus 20. These are what? Setups. These are setups. If we proceed with this, we get a cost per setup. So what's 8,000 divided by 50? 8,000 divided by 50. What do we get is the cost per setup. So the 400 is the 400, not cost. Sorry, let me remove that. It becomes the $400 per setup. So that's $400 per setup. So when you're now sharing this among A and B, if you're sharing this among A and B, the $400, please take note, it's per setup. So we then come to A. How many setups did we have for A? For A, we had 30 setups. So for A, we had 30 setups. So it means we are saying 400 is for each setup. But for A, we had 30 setups. Then we come to B. B had 20 setups, but each setup is going for 400. So that's 400 times 20. Again, something could be wrong there because it should give us, if we add these two, it should be give. So we are saying what? Sorry? It's supposed to be 60. 160, okay. Is it confirmed? Okay. So it means we are supposed to say 160 times 30. But please take note, we want per unit. This is still in, the setups were in total. So this one is still in total. After you've calculated this in total, you can then, to get per unit, setup cost per unit. If it was given per unit already, there's no need to divide the final stage. In this case, we have done our calculation from the start. It was done in total. So it means the final stage, you are going to say the cost for the setup for A is 4.8, but 4.8 is for A, we produced, is it 2,000 units? So we divide by 2,000, you get the setup cost per unit. The third 2 is for 2.5 units. You get the setup cost per unit. Can you try the same procedure can you try to do the same for ordering costs? Quickly, then we do it together. So it's actually the same, we're taking the same steps. Because the ordering, again, is given in total. They did not say per unit. Okay, are you winning? Just round the nearest 2 decimal places. Or you mean, I just round everything, transfer 2 decimal places. Huh? Okay, so let's now verify your answers. What did you get? So the next one is we are now sharing. Which cost is it? Is the ordering cost. So if you're sharing the ordering cost, our OAR is going to be based on the number of orders. So firstly, how much is the ordering cost in total? That's our cost pool. It's 10,000. So the ordering cost is 10,000 over the cost driver, the number of orders. The number of orders is 150 plus 120. That gives us what? 270 orders. So this will give us the cost per order. What is the cost per order? $7.03. That's 7.03. That's the cost per order. So that's 7.03 per order. Then we come here, we do the same calculation. We now want per unit. This was in total. We want now per unit. So per unit, we are then going to say, we first of all calculate in total to say 37.03 per order. But how many orders did we make for A? How many? Is it 150? Shayo Nyarara Tutese. The Babi. Haji? And Utopinza Shai does not want 20%. Oh, okay, it's fine. So then to that is 37.03 times 120. Then per unit now, the ordering cost per unit. So this one, it is, in terms of steps, it is a lot of steps than the absorption cost. So you realize even on the mark allocation, this will be having more marks than the first one. Ordering cost per unit. We are then going to divide. When then going to divide again is all the side. Okay, so now that we have the ordering costs, so now that we have the ordering cost per unit, let's now work out the last cost, which is the packaging. So for the packaging cost, I want you to take note of the difference. This one is, So for the packaging cost, this one is given per packaging cost. Okay. So for the packaging cost, or OAR, overhead absorption rate, we're going to take the cost pool for packaging, which is what? 20,000. Which base should we use here? For the packaging cost. So for the packaging cost, what do you think? Which base should we use? Number of orders. since there was this statement here, the organization uses a manual system for the packaging. We can use the number of hours. Of course, this, I think the statement, I wanted it to sound, I wanted to bring it out that they are using labor to do the packaging. So for demonstration's sake, let's use the labor hours. So for the labor hours, where is it different from the rest of these bases we're using? This one is per unit. So if it's given per unit, we first of all, because for OAR, we need the total. So the difference is that for the other bases, they were already given in total for each product, but we are given per unit for labor. So we first have to get this one in total. To say 2.5 is for each unit, but how many units of A do we have? Then 3 is per unit, but how many units of B do we have? Like the same way we did for absorption cost. So if it's given per unit, when you're calculating your OAR, you first of all need to get the calculation in total. So you say that's 2.5 per unit times the 2,000 units plus the 3 times the 2.5. So this will give us the cost. This will give us the cost per, these were hours. This will give us the cost per labor hour. This will give us the cost per labor hour. So what's our cost per hour? Quickly, what's our cost per hour? Hmm? 12.5, yes. For the second, for the total hours, it's 12.5. But I mean for per hour, like if we divide by 12.5. So the hours is 12.5, but what's the cost per hour? What? 1.6. Take note, this one is per hour, of which we were already given the hours per unit. The hours were not in total. The hours were already given per unit. So the difference with the calculation that we were doing above, the calculations, we would divide by the units in the end. But for this one, we are not going to divide by the units in the end. Why? Because the information was already given for each unit. It wasn't in total. So it means here to get the cost, the packaging cost per unit. So for the packaging cost per unit, there is no need for us to divide. If it's the packaging cost per unit, there is no need to divide, because this one we got the cost as being 1.6 per hour. So we're saying 1.6 per hour times. Each unit of A requires 2.5 hours. So it means the cost per unit is 4. We come to B. Each unit of B is using 3 hours, but the cost for each hour is 1.6. So for packaging cost, it was already given per unit. There is no need to divide the final answer by the number of units. But For the ordering and the machine cost, it was given in total. So we needed to divide by the number of units in the end. So now let's have a summary of the costs. Using absorption costing, what is our overhead cost? So our overhead cost using absorption costing, we are going to say machine setup cost plus the ordering cost plus packaging cost per unit. We get our overhead cost. Then the total cost, we then say the overhead cost plus the direct cost. So the direct costs are not changing. It was 15 here. I think it was 34 here. So let's compare with what we did using the activity-based costing. So this is 22.6, 43.12, 41, and 24. So it means using the absorption costing, we had under allocated the cost for A and over allocated for B. So the activity-based costing, it tends to give us a more accurate cost allocation. It gives us a better allocation. Yes, currently lesson. Can you send message for WhatsApp? Those of us Okay, let's move on. So overhead cost. Then the direct cost. So this becomes the total cost. Okay, let's just open, let me find a question that you're going to do it as homework so that at least we can move and look at other things. But let me just open it so that we check if, uh-huh. Yeah, I actually did that on purpose. In some cases, there isn't any that you have to look at the question and see from what you are given. So in some cases, those that the list that I gave you, you might not even find